Welcome back to the Money Loop, the channel where we break down money, markets, and investing concepts in the simplest way possible. Today, we're talking about something that sounds super technical at first, but is actually incredibly intuitive once you see it visually. We're talking about correlation. And trust me, if you understand this one concept, you'll suddenly understand why stocks move together, why diversification matters, and why entire markets can crash at the same time. So let's make correlation actually make sense. Correlation is basically a measurement of how closely two things move together. That's it. Imagine two friends walking down the street. If they always walk in the same direction at the same time, they're highly correlated. If one goes left while the other one goes right, they're negatively correlated. And if one person's movement tells you absolutely nothing about the other person, then there's basically no correlation at all. In investing, we use correlation to compare things like stocks, sectors, cryptocurrencies, commodities, or even entire economies. And the correlation number usually ranges from -1 to +1. +1 means two things move perfectly together, -1 means they move perfectly opposite, and 0 means there's basically no relationship. Let's start with positive correlation, because this is the easiest one to see. Imagine the overall tech industry is booming. Companies like Apple, Nvidia, Microsoft, and Amazon are all benefiting from the same trend. AI is growing, cloud computing is growing, consumer demand is growing. So when one major tech stock goes up, the other one goes up as well. That's positive correlation. Their prices aren't identical, but they tend to move together in the same direction. Another simple example is ice cream sales and hot weather. When temperature rises, ice cream sales usually rise too. Those two things are positively correlated. One increases alongside the other. Now let's flip it. Negative correlation means two things tend to move in opposite directions. A classic investing example is stocks and certain safe haven assets. Sometimes when investors get scared and stocks fall, money flows into safer assets like government bonds or gold. One goes down while the other one goes up. That's negative correlation. Think of it like a seesaw. When one side rises, the other side falls. Another intuitive example is umbrellas and sunshine. The sunnier it gets, the fewer umbrellas people buy. Opposite movement, negative correlation. And then there's no correlation. This is when two things move independently from each other. For example, the price of coffee in Brazil probably doesn't directly affect the number of movies released in Hollywood. There's no meaningful connection. Knowing one tells you basically nothing about the other. And in investing, finding assets with low correlation is actually really important. Because if everything in your portfolio moves together, they're not actually diversified. This is where correlation becomes extremely useful. A lot of beginner investors think diversification simply means buying many different stocks. But if all those stocks are highly correlated, then your portfolio can still crash all at once. For example, owning 10 different tech companies might look diversified, but during a tech sell-off, they could all fall together because they're heavily correlated. Real diversification means owning assets that behave differently under different conditions. That's why investors mix two things like stocks, bonds, commodities, real estate, and cash. The goal is to reduce risk by avoiding everything moving in the same direction at the same time. But there's one really important thing to understand. Correlation does not mean causation. Just because two things move together does not mean one causes the other. Sometimes relationships are real, sometimes they're a coincidence. And in markets, correlations can even change over time. Assets that usually move differently can suddenly become highly correlated during a financial crisis. So correlation is useful, but it's not magic. So hopefully correlation feels a lot more intuitive now. It's really just a way of measuring how closely things move together. Positive correlation is same direction, negative correlation is opposite direction, and no correlation is basically no relation. If you enjoyed this video, subscribe to the Money Loop for more simple explanations of investing and finance concepts, and I'll see you in the next one.